Happy Monday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Monday, January 29th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So we'll start with today's key macro event, which is previewing the Q1 quarterly refunding announcement. So the nuance. So today at 3 p.m., investors receive part one of the Q1 quarterly refunding announcement, which featured the net marketable borrowing and cash balance estimates for Q1 and Q2. In Wednesday's QRA Part 2, investors received the critical composition details regarding net marketable borrowing across the various tenors. These issuance catalysts have the potential to disrupt and even end the current Goldilocks market regime. From a market implication standpoint, the QRA is just one important piece of the puzzle regarding the interplay between U.S. fiscal and monetary policy and how those drivers are likely to impact asset markets from the perspective of rising or falling liquidity. Other puzzle pieces include the potential for a tapering of the pace of Fed balance sheet runoff and renewed Treasury bond buybacks for the first time since March 2000 through April 2002. We'll be closely monitoring this week's QRA and FOMC catalysts for clues because these pro-liquidity dynamics have the potential to extend the current Goldilocks market regime well into the spring. So we're looking for issuance, composition. We're looking for potential signals on the buybacks, and we're looking for potential signals on the Fed's potential tapering of so-called QT, but it's actually not QT. They're not doing QT. They're not selling bonds to the market, much like it's not the opposite of quantitative easing. So that's neither here nor there. We'll hop into our 42 macro dashboard. We'll start, as always, with our trading rate signals from our friends over at Longbow, getting an overbought signal in crude oil here on the back of the geopolitical, or so the worsening geopolitical strife over in the Middle East. Obviously, we got the attack on the U.S. base this weekend. Very unfortunate there. And then we got a overbought signal still on the Shanghai Composite. Big rally last week, obviously on the heels of a lot of important policy tinkering in terms of supporting Chinese assets and the economy with fresh liquidity from the PBOC. And then transitioning to our 42 macro aware community here. We'll wrap up with the question as always. So questions asked. Question regarding the QRA and today's QRA and Wednesday's QRA Part 2. You said investors received the critical composition details regarding net marketable borrowing across the various tenors. The issuance catalysts have the potential to disrupt and even in the current Goldilocks market regime. What we want to see to suggest a continuation of Goldilocks, and what would we see have that? Sorry, apologies. And what would we see that would have the potential to disrupt or end Goldilocks? So it's pretty simple. Obviously, if we're going to see a continuation of Goldilocks, you want to see composition of coupons relative to bills continue to be low. You want to see composition of bonds in terms of relative to bills and relative to broader coupons to continue to be low and potentially falling. Falling would obviously be a pretty significant signal as well. But we don't expect it to fall. If it just stays at this relatively low level, that would be positive at the margins. We would also want to see, with respect to continuation of Goldilocks, obviously some details on the timing and scope and size of any Treasury buyback program. Recall that last spring they signaled that they will be implementing buyback starting in 2024. Have since confirmed that in each QRA. We'd also want to see from the Fed this week if they're actually seriously considering tapering QT, air quotes there. And so that'll obviously be all very positive. And on the negative side of things, if we saw the share of coupons relative to bills inch up, and particularly the share of coupons that expire or extend well beyond the 10-year maturity, i.e. bonds, continue to inch higher, that would be negative at the margins in terms of a shifting compositions relative to what investors have gotten used to over the past kind of 4 to 6 quarters. So we'll obviously update you guys in real time in terms of these quarterly refunding dynamics. We get the part 2 at 8:30 a.m. on Wednesday. So we'll have all those details, updated charts, etc. In Wednesday's leadoff morning note. So we'll wrap it up there. Darius Dale presenting our macro minute for Monday, January 29th, 2024. Everyone have a wonderful day out there. Best of luck. And we'll catch you back here on Wednesday. I'm going to be offline tomorrow. So next time you see me will be on Wednesday. Cheers.